Want to become a successful trader? It's not just about chasing profits, it's about protecting your capital. In this video, we'll break down the critical concept of risk management, show you how to safeguard your trades from major losses, and walk you through some real life examples. Plus, stick around to the end. We've got a quick exercise to help you apply what you've learned and take your trading to the next level. What is risk management? Risk management is the process of identifying, assessing, and controlling risks in your trades to minimize losses and maximize gains. It's about protecting your capital and making sure that no single trade can cause significant financial damage. The goal isn't to eliminate risk entirely, but to manage it in a way that you can survive the inevitable downturns and still thrive in the long run. Without a clear risk management plan, even the most skilled traders can fall victim to emotional decision making and sudden market shifts. Why is risk management so crucial? Let's say you invest 50% of your trading account into a single stock, expecting a huge upside. But suddenly, the market moves against you, and that stock drops 30%. You've now lost 15% of your total portfolio in one trade. Imagine if it keeps falling and you've taken no steps to mitigate that loss. That's where risk management comes in. By implementing proper controls, like using a stop loss or limiting how much capital you commit to any one trade, you prevent catastrophic losses. This approach gives you the opportunity to recover and continue trading without panic. The traders who last in the game aren't the ones who win every trade. They're the ones who know how to manage their losses. Let's break it down with a real world example. You have a 10,000 trading account and you decide to use the 2% rule. This means you never risk more than 2% of your capital on a single trade. So your maximum risk on any trade is 200. Now, you're eyeing a stock priced at 50 per share and you set your stop loss at 45. That means you're willing to risk 5 per share. To determine how many shares to buy, you divide your total risk, 200, by your risk per share, 5. That comes out to 40 shares. So if the stock hits your stop loss, you'll only lose $200, which is 2% of your account. This approach ensures you don't lose more than you can afford on any given trade. So, how do you implement risk management effectively? Let's explore the key components you need to master. 1. Position sizing. How much of your portfolio should you allocate to a single trade? The amount should be based on your account size and risk tolerance. The more you risk on each trade, the greater your chance of significant losses. Stop loss orders. Always set a stop loss order. This is a predetermined price at which you will exit the trade if it goes against you. A stop loss helps protect your account from heavy losses and keeps emotions in check when the market turns volatile. 3. Risk reward ratio. A good rule of thumb is to only take trades where the potential reward outweighs the risk. For example, if you're risking 100 rupees, aim to make 200 rupees or more. This way, even if you're only right half the time, you're still profitable overall. Fourth, diversification. Spread your risk across multiple assets and markets. If one trade or market fails, others may perform well, balancing out your risk. Never put all your eggs in one basket. Beyond the basic components, there are additional strategies to refine your risk management plan. Trailing stop loss. As the price of your stock increases, adjust your stop loss higher to lock in profits while still protecting yourself from sudden reversals. Hedging. You can use options or other instruments to protect yourself from market downturns while keeping your position open for potential upside. Portfolio rebalancing. Regularly check your portfolio and rebalance it according to your risk, tolerance, and market conditions. Markets change, and so should your approach. Now let's test what you've learned so far with a quick quiz. See if you're ready to manage risk like a pro. So get ready. What's the maximum percentage of your portfolio you should typically risk on a single trade? A. 10%. B. 5%. C. 2%. D. 20%. Answer is C. 2%. If you risk 500 rupees on a trade and aim to make 1500 rupees, what is your risk reward ratio? A. 1 is to 1. B. 1 is to 2C. 1 is to 3D. 1 is to 5. Answer is C. 1 is to 3. Which of the following helps protect you from large losses in a trade? A. Leverage. B. No stop loss. C. Stop loss order. D. Buying more shares. Answer is C. Stop loss order. Diversification helps reduce risk. By A. Focusing on one market or stock. B. Spreading your investments across different assets. C. Selling all your investments. D. Ignoring market trends. Answer is B. Spreading your investments across different assets. To sum it up, risk management is your safety net in the unpredictable world of trading. By applying the strategies we've discussed, from position sizing and stop losses to risk reward ratios and diversification, you're setting yourself up for long term success. Remember, trading is a marathon, not a sprint. Staying disciplined with your risk management ensures that even when the market turns against you, you'll still be in the game. Now that you've learned the essentials of risk management, it's time to put them into action. Start small, stay disciplined, and build your confidence. If you found this video helpful, hit the like button, subscribe for more tips on trading, and leave a comment with your score from the quiz. Until next time, happy trading and stay smart with your risks.